Hello, good afternoon. My name is Damian Atkins. I'm the General Counsel for Aura. I've been at Aura for about 18 months. We're a proud sponsor of this event. I also spent 10 years at AOL. Started off as an M&A lawyer, so I probably bought a lot of your portfolio companies or pieces of those companies or invested in some of those companies over the years. Also made a couple of stops at Hershey and at Panasonic. Happy to be here. Love the mission, love the purpose, love the energy in the room. Looking forward to a good conversation.
Oh, we're mics, so,
She gave it to me. I don't know.
I'm Lily. I'm just the video. I mean, if those who know, it's hard to kind of make the switch. So excuse me a second because I'm in my feelings. But you got to do your job. That's the thing about VC, right? We're people, but you got to go from one thing to another. So I'm going to try to do a transition. I'm Lilia Novapuri, co-managing partner of Capor Capital. My awesome partner is over at the end, Brian Dixon. Partner at the firm, not partner in life. He has one, Mandela Schumacher Hodge, if you know her, she's awesome. I'd like to clarify that.
We're not.
I love it, but just not like that is what I say. Anyway, Capor Capital, we do early stage investments in impact-focused companies. And then on the Capor Center side, which I don't personally work for, but just want to say that we do LP investments into impact-focused funds.
Hi, everybody. My name is Laura Weidman-Powers. I'm a partner at Base 10, which is currently the largest Black-led venture fund, although perhaps someone in this room will take the title at some points. We invest in what we call automation for the real economy, which is the way technology mashes up with legacy industries. But we've built the firm on two pillars, research and purpose. We're on our third early stage funds, and we launched in 2021 a growth fund called the Advancement Initiative, where we really leaned into the purpose pillar. We through that fund, create an on-ramp into venture capital for historically Black colleges and universities as LPs by charging no fees, no carry, and having no minimums. And then we, as a firm, donate 50% of our profits from the Advancement Initiative to HBCUs and organizations diversifying tech. And I can talk a little bit more as we get into it about how that's our sort of secret sauce that unlocks our ability to get into the best companies. But I'll just add that I know a lot of people in this room from my past life, which is as co-founder and CEO of a nonprofit called Code 2040, which builds pathways into tech for Black and Latinx students. And I did that work for about 7 years, bounced around the nonprofit sector before moving over to pretty much the opposite of the nonprofit sector, venture capital. I'm very happy to be here. Thank you.
And whatever Laura touches turns to gold. So I'm going to add my comment.
How's it going, everyone? My name is Aaron Holiday. First, I just want to thank Andrea for dedicating yourself to this work. We've been seeing you build this community over the last decade or so. It's kind of a place where it's been a safe space for 645, where we met LPs, practice our pitch in the early days, and it's just been amazing to see this community continue to grow. So thank you so much for continuing to dedicate yourself to this work. I co-founded a venture capital firm called 645 Ventures. It's an early stage fund. We have 2 offices, one in San Francisco, one in New York. We have 17 people, $500 million of AUM, and 10 exits, 1 IPO that just happened last year, and 9 M&As. We focus primarily on enterprise SaaS and infrastructure software investing. So really excited to be here. Open book, so happy to share any insights that I have as I continue to go through this journey with my partner in my fund, Nnamdi Okike, who's working hard at the office.
So he pulled the short straw.
Yeah.
Okay, got it. Hey everyone, sorry I'm just coming in, but good to see all your faces. This room is beautiful. My name is Marlon Nichols. I am the co-founder and managing partner of a firm called Mac Venture Capital. We're a seed stage venture fund based out of Los Angeles. We have an office in the Bay Area and also in DC as well. One of my partners is a former mayor of Washington, DC. We are sector industry agnostic, so we invest in just about, well, not anything, but in a lot of things. Most of what we do, though, is B2B software, though we'll veer off the road a little bit and get into some hardware and some other things. Let's see. Our initial check size is roughly 3 million entry check, and for that, we ask for about 10 to 15% ownership in the companies we work with. We're very hands-on with the companies we work with. We take board seats most of the time. Other times we're observers, and other times we just spend a lot of time with them and help them with whatever their needs are. Yeah, I'll leave it there and get into the questions, and happy to be here.
With that, we have a lot of GPs and LPs in the room. You all have been through the fundraising path, the story, first fund, second fund, all of the ups and downs. Maybe talk about that, the journey. I'll start with you because you're sitting next to me and I was going down the road.
Yeah. Be careful about my seat next time. So Cape Work Capital, we've closed our Fund 3. It's an interesting path because we were lucky enough to just use Cape Work family money for our, right? We didn't have to, we didn't realize how lucky we were until we had to go out and raise Fund 3. But for Fund 0, 1, and 2, it was just Mitch Kapor and Frida Kapor-Klein, their personal wealth. Brian and I went out and raised Fund 3. It was an interesting situation, to put it lightly. I think the hard thing for us was it was our Fund 3, but it was our first time raising, so we didn't have an LP base in which to kind of draw from. But I will give major kudos to this community because I think we knew folks who had gone out there, folks like Marlon, who we reached out and were like, yo, Stephen, we were just like, hey, we know you. You know, we've been on this house. We haven't had to do this fundraising thing. You have. We've seen you do it amazingly so, like any tips. And so that was our first stop, was like to really give ourselves a good foundation from those who had built before. And they helped us with everything from intros to like, how do you set up your data room? And I'm so thankful for that. We ended up closing, I'll tell you a little. We closed 127 million. We didn't realize we had an extra million. So our press release says 126, and then we found a million somewhere. I don't know. It was really great to do that. I think for us, we really benefited as well from, our reputation and having that historical record. We had invested in over 160 companies, have 3 IPOs thus far, have about 8 companies right now who were supposed to IPO, but given the market, we're waiting for that liquidity. I know my bank account is. And so I think that also really helped us.
We are in the process of closing our 5th fund. We have 3 early stage funds. The Advancement Initiative Growth Funds was about 300 million, and we are, we'll announce later this year that we're closing our 2nd Advancement Initiative Fund. And so I joined the firm just about 2 years ago, so I've been in this last fundraise process. I've raised a lot of money for Code 2040, which is more similar than you would think. But I would say the track record is key. But for us, even though we had a great early stage track record, at the growth stage, that's sort of a different ballgame. And so what really, I think, drove the fundraising process was the differentiation of the funds. And the number of venture capital firms that exists has absolutely exploded in the last 3 to 5 years. And so if you think from the LP perspective, they're getting pitch after pitch after pitch. And the question is how you stand out and how you tell a story that is not just about why you as a firm are different, but also why you are the firm that the best companies are going to choose to work with. Because that balance of power has also shifted a tremendous amount in the last 10 years, where there were lots of companies pitching very few firms. Now there's lots of companies and lots of firms, And the best companies usually are in the driver's seat and get to choose which venture firms they want to work with. And so your ability to tell the story of why your firm is different and why the best entrepreneurs will want to work with you is what's going to enable you to win deals and make those investments, but also to inspire LPs and sort of build those partnerships.
Yeah, our most recent fundraise was last year, so we closed $347 million across 2 funds. Thank you. We have 5 funds in total. 4 of them are what we call core funds. The 5th fund is a select fund. But it didn't start off as $347 million. It started off as $7.6 million. And we called it a proof of concept fund. So we were in a seat, probably like some of the people here who are raising their first fund, and you're probably close to closing 5 million or 10 million. I remember that. And that proof of concept fund was so important because we continue to prove the same thing from 7.6 million that we're proving with 347 million. One, that we're building a team that's going to be around for a long time. So institutional LPs want to invest in institutional practices. So in the very beginning, we focused on our relationship with each other, the partnership that Nnamdi and I have, and how will that stand the test of time, and then how do we replicate it beyond Nnamdi and myself. So from the very beginning, we've always focused on how to invest in each other, and as we grow our team, we invest in and empower the people who are on our team. The second thing that we wanted to prove is that we can make money, right? So we didn't want to just raise capital for the sake of raising capital. We wanted to be able to demonstrate that we can get into companies ahead of our peers and get those companies to IPO, just like Cape Horror has done in Marlin and Base 10. So we kind of wanted to identify companies that can grow very rapidly, that can get to those exits, and work and support founders in doing that. And so that was really important in our journey as we started to make investments to implement this strategy that we call return to fund to exit. So for every investment that we make, we do an analysis to determine what would that company look like in the future if it were to return the entire fund. Not only the valuation, but how many customers will it have? What will the ACV be? And then we work with our founders to achieve that vision. And so we've been doing that from the very beginning to now. The third thing that we did was what we call pull LPs into orbit. So we pitched 200 LPs or more in Fund 1. Majority of them said no. No institutions came in. And we were really happy about all of the new institutional relationships we built when we went out to raise Fund 1. We went out to raise Fund 2, and 2 institutions came in. By the time we raised Fund 4 and 5, majority of our fund is institutional because the relationships that we built when we were coming to events like this, we maintained. We maintained them by sending quarterly reports, and we maintained them by holding annual meetings. So those are some of the key learnings. We have a bunch more, but some of the early learnings that we had that just continue to this date, I think kind of will drive us toward success.
Cool. Yeah, I echo a lot of what Aaron just said. Our journey has been kind of windy, actually. Our first fund also was 15 million, so small fund. Second, 110, third, 204. The first one, we were very close on getting an anchor investor. And unfortunately, picking your partnership is really key, or fortunately, I should say. Picking your partnership is a really key thing to do, right? And you have to make sure that you're all rowing in the same direction. We had a misstep in that, our partnership, we weren't all dedicated to building a world-class fund, right? For some of us, this was one of many things that we were going to do. And unfortunately, that cost us a pretty strategic LP relationship at the time. So we stopped at 15, but we didn't stop moving forward. And kind of like what Aaron said, we needed to prove that we could do this, right? We all had terrific track records from different investment activities that we did in the past, but we did not have a track record together, right? And so LPs are looking for, can this team, well, let me back up. I think there are 3 main things, and the LPs in the room, correct me if I'm wrong, but there are 3 main things that you're looking for. One is that the team is going to stick together, because the worst thing you can do is have a bunch of assets that you now have to manage because that GP is gone. Two, you have to be kind of in the know, right? So you got to be that magnet, that attraction point for deals, as Aaron said, before everyone else sees them, right? And then three, you got to be a good picker. So you have to, even though you're getting this onslaught of deals, you got to be able to pick the ones that are going to return the fund, right? And so we kind of, there's nothing that we could have done for Fund 1 in terms of saying, hey, we are a cohesive team, we are going to stick together. So we focused on the other ones, right? We had our 15 million, so let's go do these deals, all right? And we ended up, having a pretty good performing fund. Fund 2, going back to the partner kind of misalignment that I mentioned before, we had to have that real come to Jesus conversation. Like, this is what I want to build. I want to build a multi-generational, world-class venture firm, period. Are you with me on that or are you not? And so where we ended up was I was the only one left raising my hand. And so then I was like, all right, well, what are we going to do? And so my first partner, a very close friend of mine, one of my best friends actually, said, take the brand, do what you want to do with it, right? Build it how you see fit. And so first I started going around and recruiting, right? I was talking to a bunch of different GPs. Like, what do you think about coming and working? The first fund was called Cross Culture. What do you think about coming and working at Cross Culture, right? Let's figure this out. And I could not find anyone that I felt like, yeah, I can call you my partner today or tomorrow or whenever. And so that just wasn't working. At the same time, I was doing a lot of co-investing with another group based out of LA. They called themselves M Ventures at the time. And this was Adrian Fenty, Charles King, and Michael Palank. And so because we were doing a lot of co-investing, we were clearly interested in similar companies. But we also had varying skill sets, which is also important. So ultimately, we got together and we said, let's try something different in venture. Let's merge these two things and create this new fund and go from there. And so that's how MAC was born. So MAC stands for M Ventures and Cross Culture. It took us during the pandemic, it took us a year and a half to raise 110. But we were very particular about the LPs that we wanted to be with us. And we optimized for institutions. And the reason we did that is because it makes raising your next fund a little bit easier, right? Because institutions are in the game not to fund one fund, but to fund 2, 3, 4 funds, right? As long as you do, as Aaron said, what you said you're going to do, right? And so, so we got some pretty big name investors. We also got some luck. We invested in a company that at the time, while we were fundraising, because we were raising and investing at the same time. And we were fortunate to land in this company. We're the very first investor, $13 million valuation. A year and a half later, it was at $2 billion. So we had a few folks that were sitting on the fence while we're doing our roll and close, and they came in because that's a hell of a markup, right? But then again, we had all these institutionals now, right? And so by the time we finished fundraising for Fund 1, we're basically fully deployed. So now we had to get right back out in the street and raise Fund 2. But this time, because we had those institutional investors and because, as Aaron said, we kept a bunch of people close, like Fairview, JoAnn's going to be up here earlier. I sent her a lot of emails, and just gave them all the information. Right, we were able to raise that second fund, which was just about 2 times the size of the first one in 7 months. Right, so consistency, being deliberate about who you're targeting, and performing.
I mean, one of the most incredible things that you guys did was to come together like that. I think now is a time where there's even more opportunity because there's more and more people of color who are experimenting and building funds. And so I think that there's a lot that people can learn from that playbook of like, how do you actually merge funds together?
It's not, it sounds easy. but there's a lot of things to consider, man. Like, I mean, before we even went to legal and said that we're actually going to do this, we took about 6 months working together as if we had already done it. So they had their fund, I had my fund, and we would make the investment decisions together, right? Have those arguments and figure each other out. Like, okay, this is your trigger, that's your trigger. These are the things you're into. This is what I'm into. And then we figured out, okay, well, this is how we're going to make decisions going forward. And we like stress tested it, right? Because if you don't do that and then you end up, going all out and doing this thing, you can end up blowing this thing up, and then you're right back where you started.
Yeah, that was fascinating. We're all here. I mean, everyone here is very successful, a great track record. That's why you're here on the panel. And we all learn from successes, but we really learn from failures, right? At least for me, I learned most from failures. So could you all tell us a little bit about what's your biggest failure that you've had, and then what did you do differently after that?
Yeah. No, I'm like, which one? There's been a lot. I failed getting here today. But no, I mean, I think for me, it was a lot of the initial conversations that we had. Like I said, it was our first time fundraising. So, and we had been investing for a long time. So I think the idea we went into it was, we've been doing this. Our track record shows that we've been successful, so folks will get the story and it'd be easy. What I saw and the reality, what ended up happening was we had a lot of conversations where folks wanted us to be something we weren't. And I saw us starting to slip a little into oh yeah, we do that too. But that wasn't, what we did. I mean, Monique, we were at an event last week, and she was saying, really identifying who is your prototype LP, and that resonated with me, because if not, you can kind of get caught up in, hey, they have money, I want money, so I'll be what they want us to be.
No, we raise money all the time in my company. We play that game.
Yeah.
What are they looking for? Boom.
Well, I'm that. I'm also that, and I'm that and that. And you can't be everything for everyone. And for me, my biggest, I don't think it was a failure moment, but it was a really frustrating, why am I doing this moment is, Mitch and Frida, who were the original founders, introduced us to one of their friends. And it was this rich guy, and we were on the call. And basically he was like, I don't think what you guys are doing is right, but what you should do is, I have my kids and my daughter, she's really spoiled, and a lot of her friends are too, but they really need someone like you to teach them the importance of impact and doing better in the world. So you guys should create a program where you take rich, and I'm I can't teach your kids values. You should have done that. I'm that sounds like a failing on your part. And I actually Brian and I were in this conversation, we're slacking, this is crazy. And I'm he's well, let's just let the meeting be over. And I felt I had to say something, because I was just no, that's not what we do. And I was no, I can't teach your kids how to care about the world, because that's literally, he's they're gonna have all of this money, and he had a lot of money. And so I saw dollars, and I was well, I could do this. I could, reform, do a rich people reform program. But then I was no, that's not what I signed up for. And so, we ended the call, and I was did I make a mistake? Because he was offering a lot of, and I was no, you have, we have values. We set this up. We're doing this for a reason. And keeping that at the forefront, even when a crazy rich person offers you a lot of money, and choosing why you're doing this, even though there may be things that make you a lot of money and get your fundraising done early. I think you have, and we had a lot of conversations like that, where people are you're Black, just invest in Black people. And you're we love Black people. A lot of our family members are Black, but that for us, Cape Work Capital, our specific goal is impact. And we believe that, the founder doesn't have to just be Black or brown to create impact, positive impact in those communities. And so keeping at the forefront what our mission is, what our thesis is, what has got us this far was so important when when we had those conversations and people wanted us to be something different, and that something different came with the check.
What else?
I've spent a bunch of time reflecting on this, it was interesting being a CEO for so long and then joining a firm and seeing sort of jumping into a successful operation and seeing, what are the differences in the way that this institution or this organization is being run. And one of the things that I've reflected on is that I had this mentality when I was fundraising at Code 2040 that I was like, okay, I'm doing the work, you give me the money, I go do the work. Like, that is what I'm here to do. And what I failed to recognize was how important it was to communicate back to the people who are giving you the money what the impact of their funding is. Yes, we did some newsletters here and there, but it was really fundamentally about getting that next check from the donor. And what I've seen us do at Base 10 and what we're building out that I think is extremely powerful is building those relationships really authentically and really understanding what the LP's vision and goals are and the ways in which your work can serve and support that, and communicating thoughtfully about what are the things that we're doing that the LP is going to get really excited about. And it's different things for different institutions, and really taking the time to recognize and understand that the LP doesn't just want to write a check and then see you again for the next fundraise. They want to be engaged in the process and the work that you're doing. And I had one of our institutional LPs say, it's often the people who are doing the most impactful work who are not communicating about it. And then you get these sort of shiny things from folks who are not spending a lot of time doing the work. And so the real challenge is, how do you do the work, write the right checks, create the impact, and make sure that you're taking the time to tell that story back in a way that is engaging and inspiring and authentic. And so we actually brought on our first investor relations person this past year. And it was probably, we could have done it sooner given our AUM. It's about 1.5 billion right now. And will grow with the close that we'll announce later this year. But we think a lot about how we communicate to our LPs and the relationships that we're building with our LPs. And we're very values aligned with them and have a lot in common with them, actually. I enjoy spending time with our LPs because it's fun to talk about what we're doing and see what excites them and what they're seeing and thinking about. But it's actually a really critical part of firm building, particularly when you're transitioning to institutional capital, which is the capital that wants to build with you, as opposed to just sort of writing a check and moving on.
Yeah, so venture capital follows a very specific law called the power law distribution.
The power of what?
Power law. Power law distribution. So the power law distribution is where a majority of your returns are concentrated in a very small number of investments. And so the biggest mistakes is not a mistake of investing in a company that fails, because the most you can lose is your money. The biggest mistakes you make is when you invested in something that you didn't invest in, something you should have. That's called error of omission. That's what Warren Buffett describes it as. We had an error of omission. It was a company called OpenSea. So we are sitting around the table. Where are we going to invest this money? Oh, it hurts. It hurts. You know how these get, right? It hurts. So we're sitting around looking at the seed round for OpenSea. OpenSea had done 100K in revenue. The total market of NFTs was 600K. So we're like, this is a tiny market. Mm-hmm. And the founders are erratic on the phone, right? And so we were like, this is interesting, because we had actually looked at, we were studying NFTs and we thought it could be huge, but we didn't have enough conviction to pull the trigger on something that seemed unconventional and uncomfortable. That 500K would be 100 million. Mm-hmm. So it's not about the deals you do and you lose money on. It's the deals that you don't do, right? So just be very careful when you're looking at things that are kind of funky and uncomfortable. Take a double look and imagine, and allow yourself to imagine if this were to be true. And if you were to imagine if it were to be true, and if you're right, the outcome can be a lot larger than you probably can even model. That was one big investment mistake. Another investment mistake we made was the first investment we made out of Fund 1. We got a little scared and halved that investment. And so that investment today, we invested at a $8 million valuation in this company. The company is valued at $2 billion now. It's over $200 million in revenues and growing very rapidly. But the amount of money that we did not invest is also valued at the total value of the fund. And so what we learned in that moment, going from Fund 1 to Fund 2, is to have a relatively tight band in the investments that we make. Because venture follows the power law, you don't know which one is going to be successful. And so there were companies we've invested in out of Fund 1 where we're like, oh, this is going to be huge. And we put in like 3 times the amount that we usually put in. And that company went to zero.
Yeah.
Obviously, because most things do. And so because you don't know what is going to hit, keep a tight band from an ownership standpoint and a check size standpoint. And so when you have that IPO, you can kind of ensure that you bought as much ownership in that opportunity at the beginning, we call at entry, as possible. So those are 2 investment mistakes that we've made.
That's great. Yeah.
I mean, I started with my failure. So sorry, Mike, knows what that is. But I mean, Aaron makes some really good points, right? Venture is it's a game of home runs, right? It's how many of these do you knock out the park? And one other thing that he said that was really important: fund construction, right? Just set it, stick to it, right? And then I was talking to someone associated at another firm the other day. And she was saying, her firm was looking at this deal, but they were willing to put in, a $250K check as opposed to their core check, which is more like $1 million, right? I'm like, well, if they're willing to put in $250K, why wouldn't they be willing to put in $1 million, right? Because either way, you're gonna lose. Either you're gonna lose the $1 million, you're gonna lose the $250K, or you're gonna, win multiples on top of that $250K or that $1 million. So, one thing that I've learned over the years is like, if you're not willing to put $1 into, if you're not willing to put the full amount into it, don't put $1 into it. It's not worth it. You don't have the conviction, right? And if you don't have the conviction, don't do the investment. So I'm glad you brought that up.
Yeah, that was great. So we've talked about its importance of alignment amongst GPs, having alignment between your fund and the LPs, building relationships through communication, constant touch points, the power law distribution. That's something I'm gonna have to look that one up and talk to my CEO about. And then a tight band amongst all your investments. I mean that's critical. Well, that was fantastic. I want everyone to give a great applause to the great panel.